Welcome from the team at Acceptance Finance and our series we're calling A Focus on Finance. The basics of this 5-disc series will be to share some knowledge of the lending and borrowing process that we have to go through in Australia when we're looking at purchasing property. Many courses and seminars that you may have looked at over the years or been to for property will have covered finance in some description or another, but only briefly, or they're so full of jargon or technical waffle that you just simply can't understand or get a grip of what they're talking about. Same here today, we're not going to try and turn you into financial gurus, we're just going to try and arm you with a clear understanding of the finance process in this country and what it takes to get your application approved, and why lenders make some of the decisions that they do. It doesn't matter if you're a first home buyer, an upgrader, a first time investor, or investing for the 101st time. A little inside knowledge may help your travels through the financing maze a little easier. It may help you overcome some of the common mistakes made when trying to borrow. As we said, we don't want to turn you into financial experts, but the goal of this 5-disc series is to put some of the jargon into layman's terms, to give you a clearer understanding and a broader understanding of the financing requirements you will need to get funding approved, be that for investment or an owner-occupied purchase. Our intention is to start at the beginning, preparing to borrow, and through the whole process right up to settlement. To do this, some of the information will seem very basic, especially to those of you that have been through this process once or twice or a number of times before. However, even if you've done it 100 times, we are still confident that you will learn something from this series. You may even think you're already an expert, and congratulations, I hope that you are, but sometimes the word expert is a little bit overused. As soon as you think you know everything, things change. A daily occurrence in the world of finance. Since 1990, when Acceptance Finance was first established, financing and finance options have continually changed, and they will continue to do so. This series will give you strategies and tips to put you in the best position no matter how finance policy changes. Things do change, but as a wise man once said, the more things change, the more they stay the same. I was once told when presenting, don't apologise. If you make a mistake, people won't know anyway. At first I thought this was a little bit arrogant. However, they weren't talking of technical mistakes or the information provided, but mistakes or stumbles in the way you present or get the message across. My style is basic and to the point, the same way I've dealt with my clients for many years, and they've told me that they appreciate it. In an industry that loves jargon, we'll try and help you understand. For those that like my style, I thank you, and for those that don't, my apologies. But as they say, you might please most of the people most of the time, but not all the people all of the time, or something like that anyway. Hopefully that's my one and only apology. So let's get underway. Getting started. Putting your house in order. Strategies that will help you maximise your borrowing capacity and your ability to buy property, be that for investment or for owner occupation. Getting ready to borrow for the first time, or as we said, the 101st time. Used correctly, it will help you secure, finance and maximise your borrowing potential. The first step in any process when you're looking to borrow money is not rocket science. You need to budget. You need to know where your money goes. It never ceases to amaze me, from a first-time buyer to a multi-level investor, and from an employee to a CEO that's running a very successful business, how little knowledge they sometimes have of where their personal income goes. Well, you need to. Maybe not always every cent, that might come later, but you need to have a firm grasp of money in versus money out. This will give you a little indication of when I started work. My dad once told me, Colin, you earn $38 a week. You can't spend 40. If you do, you're going to go backwards. So let's take Dad's advice and begin with step 1. First, you need to tally your income from all sources. Now, there's no cheating here. You can't use potential income. You can't say, I'm going to work every Saturday now, or I'm going to get that bonus this month, or I'm going to get that bonus commission at the end of the quarter, you need to tally your income based on what you have earned to date. Once you've done that and you've got a clear estimate of what you do earn, you need to then analyse your money out, which is step 2. You need to collate your bills, your living expenses, your repayments, and any personal spending. If you go out for dinner every Saturday night, you need to tally that in. You need to know how much money you've got coming in and how much money you've got going out. You don't need to do a full budget analysis, as I said, right away, and we're not going to do one here. But at some point you may need to, and you can get help from that. You can look on the internet, there are books on budgeting. Look, there's even classes now where you can do on budgeting. And if you need that help, seek it. But even a basic budget analysis will give you an indication of your capacity to repay debt. To paint a picture for a lender, first you need to know yourself. One of the biggest problems is bad debt, and that is non-tax effective debt. That is simply a debt where the value of the purchase decreases faster than you can repay the debt. A typical scenario would be for this where you went out and bought a car on a personal loan and the value of the car is decreasing quicker than you can repay the debt. Credit cards can be bad debt, personal loans, personal leases, so-called interest-free purchases, probably one of the worst, hire purchases, and any other personal debts. Loan applications stumble as these severely affect your capacity to borrow. The most common, of course, is high credit card limits. Let's say you have a $20,000 credit card limit. I don't know how many times I've been told by clients, "Oh, Colin, I've got a $20,000 credit card limit, but I only use $3,000. Well, if you've only used $3,000, don't have a $20,000 limit. Take a $20,000 credit card limit. Even if you're earning the average income in the mid-60,000 per year, this can lower your borrowing capacity by as much as $70,000 or even $80,000. Even more if you earn less. That's just with a $20,000 credit card debt. So what do? First, lower your unused limits. Cancel non-essential cards and debt. What if you maxed out and can't lower your limits? If you have no equity in property, you must reduce the higher interest debt first. Look at the loan balance, look at the interest you're paying, and pay that debt down first. Look at transfers on credit cards even to a lower rate credit card, but be careful, some of these aren't everything they seem. If you do have good equity in property, you may look at consolidation of all that small debt into the mortgage. Now, often people advise us not to do this as the debt is over a longer period, and that is true, but we need to look at our goal here, and our goal is to increase your borrowing capacity. The same credit card debt of $20,000 that reduces your capacity to borrow by $70,000 or $80,000 may only reduce your capacity by $15,000 or $20,000 if it's in a mortgage facility. The reason for this is that the payments are spread over a longer period and are less, thereby increasing your capacity to borrow and effectively reducing your immediate debt level in the eyes of the bank. This could potentially allow you to borrow around $50,000 more with certain borrowers. Obviously the figures vary given your income, what interest rates are, but the story remains the same. It enhances your capacity to borrow. So, okay, what if I don't have equity in property? Well, you can still look at consolidation. You may be able to look at all your small debt and consolidate it into one personal loan over a longer term. Quite easy now to get a personal loan over 7 years. This will lower your overall payments, and again, it may increase your capacity to borrow. If you are consolidating into one personal loan, make a commitment to continue with the original payment that you were making on all of those debts prior to taking out the personal loan so that you can eliminate that debt much quicker. Once the debt is eliminated, commit that payment to savings to put together a deposit for property. If you thought there was a magic pill, I'm really sorry, but there's not. It may take you a little bit longer to get where you wanted, but if you don't make a start, it'll never happen. So start now. Another area often overlooked when making a loan application is record keeping. Lenders want to lend money. The secret? Giving them the information they need to say yes. After researching a lender and product, how the application is presented to that lender and the information that is given to them has a huge bearing on the outcome of that application. Record keeping can have a major influence on your application. Many times a client will tell us their base income isn't really what they earn because they get commission, they get overtime, they get bonuses. But you can't just tell a lender. They will only look at the historical evidence, records. And they will look at established patterns over 1 and even 2 years. You need to keep pay slips, group certificates, ATO notice. If you've got no evidence, it doesn't count. Savings evidence is really important, and the longer it is kept, the better. Any alternate income records, such as dividends you might receive regularly, rent from current investment properties, interest from managed funds, family allowances, anything. All of these and many more may enhance your borrowing power. If you're self-employed, keep BAS statements, keep tax returns. If you've reduced debt in a big way, keep records of that. Any extra super payments, depreciation schedules and allowances on your tax returns, your trading accounts. Clear and concise records may help, even for low doc loans, which we'll talk about a little later. Profit and loss statements, BAS statements, trading account, cash flow, all may help support your application. The days of simply stating your income are largely over. Lenders love history. Even little things may help. A good broker or loan manager can decide what to use if you have kept records. For the final part of Disc 1, we're going to go through some of the common terms used in lending. We're not going to cover them all by any means, but some of those used more often. Untangling some more jargon. The first of these terms is LVR. LVR is a term the banks use very often and one that you may have come across before. LVR is simply the loan to value ratio. The percentage of the amount you borrow taken against the value of that property. So if the property's value is $250,000 and you borrow $200,000, you're borrowing 80% of the property's value, or an LVR of 80%. If you borrow $125,000, you're borrowing 50%, or an LVR of 50%. Same, whichever way you go. Borrow $225,000 and you're borrowing 90% LVR. As we'll see down the track, this comes to some relevance later in another common term. What you have to remember though is you may have paid $250,000 for the property. What comes into play now is when it gets valued, if it is valued at $250,000, that is what they will lend against. And generally when you make a purchase, more often than not, the valuation comes in at the purchase price. But if it comes in less, they will use that lesser amount to determine the loan to value ratio. So it is the contract price or the valuation, whichever is the lesser, they use to determine the loan to value ratio. The next term we're going to talk about is one that you don't want to hear. The next term is foreclosure. And simply put, foreclosure is the process a lender will go through to recover the property if you don't meet the terms and conditions of the loan. So you don't want to hear the word foreclosure because it means the lender is coming after the property. Now, if a loan is in default, which is our next term, you get behind in payments, or whoever owns the property gets behind in payments, you get served notices, you're in default of the loan, and then they begin foreclosure. So default and foreclosure are two things that you don't want to hear. The next one, and this relates heavily back to LVR, is the term LMI, which you may or may not have come across. At some time you certainly will if you're buying property. LMI stands for Lender's Mortgage Insurance. Now, when we were talking about LVRs a little earlier, and the percentage you borrow, typically on a fully verified loan, and that is a loan where you can prove your income and you can prove service capacity, LMI, or Lender's Mortgage Insurance, starts at 80%. So Lender's Mortgage Insurance begins at 80% value and above. The higher you go above 80%, the higher the premium on that Lender's Mortgage Insurance. The higher amount you borrow, likewise, the higher the premium. Now let me cover one thing here. Lender's Mortgage Insurance does nothing for you, the borrower. Lender's Mortgage Insurance is an insurance that the lender takes out to cover any loss on the property should they have to foreclose. So that is why the higher the loan to value ratio and value, the higher the premium. Lender's Mortgage Insurance does nothing for you. If a lender forecloses on a property and they incur a loss, then they will look to the lender's mortgage insurer to reimburse them that loss. The next term we're going to look at is credit rating. Now, one of the first things people say to me when they come to see me quite often, or they see some of our brokers or some of our team, is they say, "Oh, but I've got a good credit rating." Well, let me cut that one little misdemeanor out here. There is actually no such thing, really, as a good credit rating. There's only such a thing as a bad one in the eyes of the bank. While the record keeping we spoke about before can show the bank your conduct on your current borrowings, only a credit check can show them if you've defaulted on those borrowings or had any financial judgments. A credit rating, therefore, really can only be bad. You can't have a good credit rating. I spoke there quickly of the Credit Reference Association of Australia, which is known as CRAA. And this is the next term we look at. All of your credit inquiries, meaning every time you've applied for any form of credit, even as much as a phone account, will be listed on your CRAA. Any defaulted payments may appear, which will show a bad credit rating. Any court judgments in a financial term will be shown. And how many inquiries you've made for finance will be shown, which comes into importance in our next term. So while a lender may be able to tell how much credit you've applied for and who with over a number of years, they can't actually tell whether you've repaid that debt smoothly and effectively. They can only tell if you haven't by having a judgment or a default listed on your credit rating. And that's why I say you really only can have a bad credit rating. Credit score is the next term we want to look at because it comes in with your credit rating and your CRAA. Your credit score is becoming more and more important. A bank will check your credit file for part of your credit score. How many credit applications you have made can have a big bearing on your credit score. Your job history, your job stability, your address history, your address stability, all of these things and many more can affect your credit score. And it can affect your application. So that's why one of the reasons why you don't want to be out applying willy-nilly for all sorts of forms of credit. For example, when you put an application in, if your application says that you have one credit card, but your credit file clearly shows that you've had 6 applications for credit cards over the recent period, the bank's going to ask why. Why are you stating you've only got one credit card when we can clearly see you've applied for 6? Even checkable employment, phone numbers, your age and your asset position, your asset over liability position, meaning what you own over what you owe, can affect your credit score. A good place to start is to check your own credit file first. Now you can do that at www.mycreditfile.com.au, and you can actually order a copy of your own credit file. And it is a good start if you want to look at borrowing. Getting back to the common terms, a couple more common terms that we want to cover is assets and liabilities. Now I'm sure you understand, but let's take a little bit of a closer look from a lender's perspective. Assets, as far as a lender goes, are real estate, motor vehicles, your savings, any deposits you might have. Some will take superannuation into contention, the contents of your home, tools of trade, equipment to run your business, any insured jewellery, business stock in some cases, shares. What an asset really is and what it really means is a tangible, realisable asset. Accounts or funds that are owed to you are not yet an asset because they're not a tangible asset. You haven't received the funds for them. Liabilities, on the other hand, are anything that you owe money on or must repay. Personal loan repayments, credit cards, leases, mortgages, guaranteed loans, a loan that you've guaranteed payment for someone else, a tax debt, private school fees, maintenance that you have to pay, living expenses, anything and everything you might have a commitment to pay can and will be counted as a liability. Calculating your asset over liability position shows what you're worth. Simply meaning, let's count up your assets, let's count up your liabilities and see what you're worth. See what you've put together to date. When it comes to liabilities and your income, it also gives a lender an indication of your capacity to service future debt. Another common term now that we're going to use is income. Now I know it seems obvious. People think my pay packet or my tax return. But there's many variants on income. There can be salary, bonuses, commissions, dividends, interest received, maintenance received, a car allowance, company cars, incentive payments, profit sharing, second jobs, rental received, salary sacrifice, and others that aren't so obvious. With self-employed, it gets even more complex. We might be looking at company profit shares, depreciation add-backs, non-recurring interest payments, lump sum super payments, and many, many more. Picking the right lender and having the right records can have a huge bearing on how much you can borrow and conversely, how much any individual lender will lend you. The next term we want to look at, now this sounds a little bit funny, the next term we want to look at is term. Imagine having on a DVD series of common terms a term called term or loan term. A loan term simply means the time that loan is taken over. It is called the term of the loan. Now generally when we're talking about residential mortgages, that can be 25 or 30 years. It used to be 25 years quite regularly. More often than not now it's gone out to 30. The term quoted on your loan contract is the maximum term of that loan. Generally you can pay it out in less time, but you can't take longer than the term quoted on your loan application and the loan offer that the bank makes to you. The next term is also one you will all have heard before, and that is simply interest. The premium that you pay to the lender for them to lend you the money. This is how a lender makes their income. Now, there's different forms of interest. Interest only, principal and interest in advance. Interest only is quite simple, really. Let's say that you borrow $100,000. So you borrow $100,000. I'm sorry to use the K, but it's actually a little bit shorter to write it. So you borrow $100,000 and the interest is 10%. So if you're making interest-only repayments, you simply have to pay back $10,000 or 10% per year, because interest is generally taken on a per annum or a per year basis. What happens though is you pay interest only, and at the start of the year you owe $100,000, and at the end of the year you still owe $100,000. Now, if it is an interest-only term loan, now it might be 5 years interest only, that'll mean at the start of the 5 years you owe $100,000 and at the end you owe $100,000. Generally used for investment to keep the debt tax effective and allow you to maximise your claims against any investment. It can also be used to lower repayments in those initial years. The next type of interest is what's known as P&I, or principal and interest. This will generally be used on owner-occupied homes. Now, unfortunately, I can't do as simple a calculation there as I can for principal and interest, because calculating principal and interest over a longer term loan is much more complex. But if you'd like to go to our website at www.acceptancefinance.com.au, there will be a calculator you can use on there to put in your interest rate and calculate your repayment only over any given term of years. Another form of interest that is quite often used, but not as often as interest only or principal and interest, is interest in advance. Now, generally this will be used only by investors. And what it can do, without going too deep into it, if someone, say, that is self-employed or has a high income and they want to take their deduction quicker, they may pay all of their interest in advance before the end of a financial year for the following year, so as to be able to claim the deduction on that interest in that financial year. So there's a brief on interest terms. The next term I want to cover is loan balance. And that is really simple also. Your loan balance is simply how much you would have to repay to clear the loan at any given point in time. Now, you would have to pay that loan balance plus any exit costs that may be incurred. The next terms I want to talk about are variable and fixed interest, the two most common types that we use. Variable interest is simply a floating rate of interest. It can go up or down at the discretion of the lender. Generally, it is based on a cost of funds. Now, we've all seen every month the Reserve Bank meet and set a benchmark rate, but this is not the clear defining rate. It is a guide to interest rates, but banks get their money and lenders get their money from many different sources. They might get it from deposits, they might get it from mortgage bonds, they might get it from overseas. They get it from varying different avenues. Now, they will base their variable rate on the margin they need to make a profit. So, by context, variable means the loan can go up and down. Fixed interest simply means that for the term of the fixed part of the loan, the interest stays the same. Now, when we're talking about mortgages, the most common fixed periods are 3 and 5 years. But really, you can fix a loan now almost anywhere from 1 to about 15 years. But you have to be a little bit careful. There can be restrictions. You may have a fixed payment. You may not be able to make lump sum payments and pay it off earlier. You may have higher exit costs should you need to get out of the loan. They may provide you some peace of mind, but before taking a fixed loan, you just need to consider all of the factors. Now, I made mention before of low doc loans. So the terms I want to talk about now are low doc loans and fully verified. A fully verified loan is simply a loan where the lender can clearly document your income from payslips or group certificates or tax returns or your work contract. And even on contracts or self-employed, they will generally take in a 2-year average on those type of earnings. Payslips and group certificates for employed people, they will work off your current income. Low doc loans is a loan where you can't fully verify your income. Now, before the GFC, if you wanted a low doc loan, if you were standing erect with a pulse and signed a form saying that you could repay the loan, they might have given you the money. And that's why we had the GFC, because principally that's what a lot of lenders overseas did. They lent money to people that never should have borrowed it, at loan to value ratios way over what they should have lent at. And this all collapsed. So low doc loans have become a focus of more interest now. There may be some onus on you to provide some evidence to justify the income you're stating. You may be required to provide BAS statements, trading account statements, but there will be some onus on you to prove it. It is still possible to get low doc loans where you don't have to provide this evidence if you have a good, clean credit history, but the LVRs are much, much lower now. The next terms I want to cover are negative and positive gearing. Negative gearing is actually when you make an investment and it makes a loss. Now that loss can be actual or theoretical. Let me explain a little bit. Let's say you have a property and it rents for $300 per week, which equals $15,600 per annum. Most figures a bank user or a lender uses will be taken out to a per annum figure. Now, let's say, on the other hand, that property in holding costs such as rates, maintenance and everything else, plus the interest on your loan, costs you $20,600 a year to service. That means you've made a paper loss of $5,000. That is known as negative gearing. If the property is held in your personal name, you may be able to deduct that loss from your personal taxable income. Positive gearing is simply the opposite. If the property brings in $15,600 a year, but only costs you $10,600 per year, instead of a loss here, we have theoretically or otherwise made $5,000. Now again, if that property is held in your personal name, that income may be added to your personal income and taxed at your marginal tax rate. Now, we haven't covered all the common terms, obviously, and we're going to make a more comprehensive list available on our website. So if you go to our website at www.acceptancefinance.com.au, you will be greeted with a PDF on common lender terms, and you'll be able to download that and read an explanation of many more common terms. Now, in summary, I'd like to cover off a few things. Our aim here is to give you a guide only. You should borrow only after research and consultation. Future DVDs will cover many areas. The next disc we look at, borrowing entities, what are they, and what might be the right one for you. We also look at pre-approvals, the pros and cons, and we look at first home buyer grants. Now, whether you're a first home buyer buying or whether you're an investor selling to a first home buyer, it is important you understand the first home buying process. Further on, we'll look at the right lender, the right product, the loan process from application right through to settlement. We'll look at some contract dangers and how you might be able to avoid them. We'll take a bigger look at fixed versus variable interest, interest in advance, line of credits, interest only and principal and interest. Negative and positive gearing will be looked at more closely, and the effects on your borrowing. We'll look at buy, hold positions, buy, sell positions, buy, hold and flip developing. We'll also look at some exit strategies for reinvestment, for profit and for retirement. So until next time, thanks for listening. Thanks for watching this DVD. It's our hope that you have learnt something from it, and stay tuned for disc 2. Thank you.